Welcome to our revision lecture on financial instruments. I'm pretty sure when you saw this page that you wanted to run away. Now guys, please do not run away. Stop, turn around, come back, sit in front of your screen and look at this page. Now you will identify on your right hand side that I have included a legend. Now what is a legend? If you have audited before, a legend provides the reader with abbreviations, words, signs that you have used in your notes. Now you will identify that I have used a significant amount of colors in our notes. For example, when I refer to financial assets at amortized cost, I have used green. Financial assets at fair value through profit and loss, blue. Now why? Financial instruments include a significant amount of theory that you need to study. And remember, our focus is long-term memory. Therefore, I have used different colors. Every time when I talk about amortized cost, I've tried to use the green. Then the other important thing is my musical note sign. You will identify that I use the sign when I talk about instruments. Now, I have mentioned to you before that I study using pictures. Therefore, this is the sign that I have used since 2006 to study financial instruments with. Financial instruments will be covered in 3 separate standards. Our first standard, IAS 32, indicates to us how to present our financial instruments as either financial asset, liability, equity, and so forth. Once we have determined our presentation, we can move on to IFRS 9. IFRS 9 indicates to us how to recognize our financial asset or liability at initial recognition and our subsequent measurement. Now, it is important that you identify that first you had to determine if this is a financial asset or financial liability in terms of IAS 32. Then only can you apply IFRS 9. Now, IFRS 7 indicates to us how to disclose our financial instruments. You will identify that I did not include any notes. Please, you need to read IFRS 7 on your own as self-study. Ensure that you highlight, flag, underline the standard properly. Why? When a requirement indicates to you to disclose in terms of IFRS 7, immediately you can open IFRS 7 and you should be able to briefly read through the requirements of what should be disclosed. I'm going to focus on our presentation and recognition in this lecture. Now remember, I've indicated to you that I have divided this page into a few smaller pages, or not smaller, same size, but with less information. Our second page, we will only focus on IAS 32, our presentation. IAS 32 provides us with a few definitions. Now, the first very important definition is what is a financial instrument. Now, this is a contract between 2 entities that will result in a financial asset being recognized in the one entity's records and a financial liability or equity being recognized in the other entity's records. Now, on your right-hand side, you will identify a very basic example. A provide a loan to B. In the financial records of A will debit a loan receivable, and this will be a financial asset, and credit bank as our bank decrease. In the records of B will debit bank and credit loan payable, and this will be the financial liability recognized in B's records. Therefore, when we look at our financial asset, a financial asset complies with the definition of our conceptual framework. This will be future economic benefits that will be received by the entity. That entity will receive something in future. And financial liability links to our conceptual framework an outflow of future economic benefits. There has to be an obligation. Now guys, important, write this down. You need to remember, when we talk about a financial liability, there has to be an obligation. And then we may recognize that liability. And then number 3, equity. What is equity? The definition indicates to us that this is the residual interest in an entity after deducting all of its liabilities. Therefore, guys, normally assets minus liabilities. Then IAS 32 indicates to us that compound instruments will include a portion that is a financial liability and a portion that is equity. Now, how do we calculate this? We have steps that we need to follow. Step 1, calculate the fair value of the instrument at initial recognition. Step 2, calculate the present value of the liability component based on our market-related rates. And step 3 will be the difference between step 1 minus step 2, and this will be our equity. When there is transaction costs, you need to remember to allocate this proportionally between the liability and equity. Now guys, extremely important. I have identified that there's a lot of our students that do not know the characteristics of preference shares. If you do not know this, you need to study this, please. When we look at a cumulative preference share, what is the meaning of cumulative? What do you need to remember? Number 1, we may not declare dividends to our ordinary shareholders if we have not yet declared the dividends to our preference shareholders. Therefore, our preference shareholders should always receive dividends first. Number 2, if we have not yet recognized and declared dividends to our preference shareholders, we need to provide a liability. Why? There's an obligation that we need to pay our preference shareholders. Therefore, it is important that you identify that preference shares have 2 cash flow streams. The one relates to our preference dividend and the second to our capital portion. Therefore, preference shares can either be recognized, 1, as only a financial liability or equity, or 2, as a compound instrument that includes financial liability and equity portion. If this is the case, you need to know that you will have to follow our steps on calculating the different portions. Let's move on to our treasury shares. Now, what is treasury shares? This is when the entity reacquires its own equity instruments. I'm going to explain this by means of a very basic example. If we register a new company with Sub C, we need to keep a share register in terms of our Companies Act. Now, when we register that company, we need to register authorized share capital. Now, authorized share capital is the number of shares that the entity has available to issue. Let's say, for example, 1,000. Then there is issued share capital. The issued share capital is shares issued from the authorized share capital. Therefore, For example, if we issue 100 shares, our journal entry will be to debit bank and credit our share capital with 100. Okay. Guys, do you see our authorized shares balance will now be 900. Why? 100 is issued. Now, when the entity reacquires its own equity instruments, they buy back their shares. Therefore, they can now buy back 50 of the 100 issued, remaining 950 authorized shares, and our journal entry will then be to debit our share capital with 50 and to credit our bank. And that is treasury shares. No gain or loss will be recognized. Now, when you look at our financial instrument definition, where we have a contract between two entities, A and B, do you see that it is easy to classify our financial asset? This will be where there is a debit side entry. It is difficult to always determine if an instrument is a financial liability or equity instrument. Remember, liabilities and equity both increase on the credit side. Therefore, how do we determine if an instrument is a financial liability or equity? Now, the standard provides us with a guideline, and you will identify that I have included this diagram at the bottom. Our first question that we need to ask: is there a contractual obligation to deliver cash or a financial asset? Guys, extremely important. We have already indicated that if there is an obligation, we need to think about a possibility of a financial liability. Therefore, if there is a contractual obligation, immediately we can identify that this will be a financial liability. If our answer is no, we need to ask question number 2. Will the contract be settled in the entity's own equity instruments? If the answer is no, this will not be equity or liability. If the answer is yes, we need to ask number 3, the number of shares. If this is variable, we will recognize a financial liability. If the number of shares fixed, we will recognize equity. Now guys, substance over legal form. If we look at our preference shares, if we have cumulative preference shares, how do we recognize our cumulative preference shares? If we look at our dividend portion, do you agree with me that there's an obligation to pay our dividends to the shareholders? Now this is fixed based on the number of shares and the percentage. Therefore, substance over legal form, this portion shall be recognized as a financial liability because the entity has an obligation to pay the shareholders, even if this is based on a fixed number of shares on a fixed percentage. Then I want to indicate to you, when you need to determine if financial instrument is an asset, liability, equity, you always need to look at this from the issuer's perspective. Now I want to look at derivatives. What is a derivative? Now this is a financial instrument or contract that meets all 3 of the following characteristics. The first characteristic is that this financial instrument will change due to a change in a variable. For example, interest rate, foreign currencies. Number 2, there will be no or small amount of net investment invested into this financial instrument. And number 3, this will be settled at a future date. Now, what is examples? This can be share options. Remember, a share option is a right provided to buy or sell shares in future. Therefore, guys, this is a right. This is not shares being issued. Number 2, foreign exchange contracts. Remember, foreign exchange contract is an agreement under which an entity agrees to buy a certain amount of foreign currency on a future date. For example, if we have an entity, let's call this ABC, that purchased goods from US Limited, and the goods purchased is an amount of $100. But the payment date is only within 6 months from transaction date. Now that entity enters into an agreement with the bank to purchase the $100 at a fixed rate on payment date. Therefore, guys, important in this transaction for our level 2 students that you are able to link this to your IAS 21 rules. Why? At transaction date, recognize the transaction at spot rate. If there is a year end, you need to remeasure your creditor at spot rate at year end. And on payment date, you will have to remeasure your creditor and recognize payment. The financial instrument relates to the transaction with our bank, and this will result in a FEC asset or liability to be recognized. And then number 3 will be our interest rate swaps. Now, what is this? This will be, for example, when we have 2 entities. The one entity will pay interest at a fixed rate, and the other entity will pay at a floating rate. And they decide that they want to swap their agreements with each other. Then all interest, dividends, losses, and profits that relate to financial instruments or a component that is a financial liability shall be recognized in our profit and loss. Just a quick one, guys. Debentures. What is a debenture? A debenture is a form of a long-term loan. Therefore, when you read that they indicate to you that this is a debenture, you need to know that this is a type of a long-term loan.